All right.
All right.
So let's talk mortgages.
Okay.
Mortgages, interest rates, where things are going, where things were. Give me your take on the. Let's rewind. Give me your take on the 12 months leading up to super high record housing prices, ultra low money. What were your thoughts on what, let's say, the central banks did, bringing money to what, 0.25 overnight lending rate?
When you think about it, we had that sort of, well, when COVID hit, I guess you had that housing surge, but at the same time you had ultra low interest rates. I mean, I was locking people in for fixed rates at like 1.59, 1.79, right, for an insured or insurable mortgage. So I mean, at that point, you kind of scratch your head and like, this feels weird. Because at that time, the 10-year, like the average 5-year rate over the 10-year span was 5%.
Yeah.
So you're well under what the average was at
Like
the time,
crazy
right?
under.
Yeah, ridiculous amounts, right? So you're not even paying 2% on money, which also is like kind of a head scratcher.
Yeah.
Right? So I mean, we've gone from head scratcher low to head scratcher high. So I got a mortgage business around 2005. And
So hold on. Okay, so 2005, what was roughly 5-year fixed 25 AM?
579.
579.
Yeah.
Okay.
So I mean, I'm full circle in my career.
Yeah. You're
so
back up
it's really weird. Yeah, back up to where it all began, right?
Yeah.
Started from the bottom, now we're back again, is what Drake would probably say.
You might want to talk a little louder because.
Oh, really?
Yeah, you're a little low voice.
Am I?
Maybe. I don't know.
Thanks for that.
Just letting you know.
Yay.
Okay. So then in the mortgage world, when all of these glorious supreme leaders that I kind of reference them that way these days because.
Am I one of those leaders?
No, like like the central bankers and like all these government people who you're really struggling with the mic.
I'm very strong.
So
Keeps going.
what, like, when rates went to these ultra low levels, what was being said in your world, like behind closed door? You know what I mean? Like, no one's gonna obviously come out, like no lender's gonna come out and say, okay, the Central Bank of Canada or the Federal Reserve in the States is bloody nuts because this is going to lead to a problem. But, like, did you guys have those kind of, like, call it, like, okay, in the end, this is going to go bad?
If you've been around for a while.
Yeah.
And you're just like, okay, so what's going to happen? So I started at 579, then it went down,
Yep.
and you just pour a bunch of business in, right?
Yep.
So the spreads are still okay for the lenders.
Yep.
But then, it's always a play of what's volume doing versus, the profitability per mortgage, right?
Yep.
So there's always that game. So they're always playing that game, and they're always giving us. Sometimes we get like compensated on different deals where they want to fill their buckets,
Yep.
right? So I want to fill their buckets on like 1 or 2 year terms. So here's like a pay bonus because we want to balance out our balance sheets. But we're sitting at 179, and of course everybody just wants to break their mortgage.
Yeah.
And pay crazy.
Well, why wouldn't you? I mean, if you're paying
Absolutely.
325, why wouldn't you? Okay, no, I'll pay some penalty. Maybe, like, obviously.
You do the calculation on it. But I mean, people were
So-
breaking mortgages for like 20,000 because it just made sense. Because you're 379 and I can get down to 179.
So what?
Okay.
Yeah, I guess so. In an example like that, what would it, like, what was it costing somebody to, or maybe explain, like, how are the costs associated with breaking a mortgage?
Yeah, so there's a couple different things. I mean, if you're in a standard, what's called a standard clause mortgage, which is not a low rate basic mortgage. A low rate basic mortgage means there's certain penalties or stipulations, and massive penalties and stipulations if you break your mortgage early.
Yep.
So if you're in a low rate basic product or a value plus mortgage, there's a whole bunch of different marketing behind there. But if you're in a restricted program, a lot of the time it's like a 3% penalty.
Yeah.
So it's 3% on the balance, no matter what. Even if you stay with the same lender, sometimes they'll reduce it and that kind of stuff. So there's that sort of caveat there. And you can get a variable rate or a fixed rate in that.
Yep.
Low rate basic mortgage. If you have a standard variable rate clause in mortgage, it's generally a 3-month interest penalty.
Yeah.
So on average,
that's,
you're anywhere $2,000
which
plus
is
a discharge
nothing when
fee
you're
of like $400.
Yeah.
Who cares?
Yeah,
if
so
you're breaking it, you're saving $60,000 over the next 4.5 years.
Yeah, it's a no-brainer.
You need a couple grand.
Yeah.
You'll be okay. Your net, is far ahead. So it's worth baking that into it, right? If you're in a fixed rate, it depends on how long and how far you are into your term of the mortgage.
Mm-hmm.
So the earlier in the term, the more penalty you're going to pay.
Yep.
So on average, they take the difference between what you're paying and the discount that they're offering you on the new rate. You take that on a monthly basis and times that by your remaining month. So it's called an interest rate differential.
Yeah.
So that could be, there was penalties, I saw penalties in the 40,000 mark. If you had a penalty, if you had a mortgage size of like 400,000, penalties were like 36.
And were people still like, no, in the end, over the next 5 years, this makes sense?
Not at that point. The break even wasn't there. The break even was kind of on average.
Yeah.
It would make sense if you were like 16 to 18,000 in a penalty. Yeah. We would break that. It would make sense at that lower interest rate.
Yeah.
But then you have the conversation. It's okay. So we're having sort of increased prices and low rates. Oh, I'm calling everybody to get equity out of their house.
Yeah.
Hey, Jim, I know you wanted a pool. Hey, I know your kids are going to Harvard. Hey, everything, right? So why don't we take advantage of that, right?
Yeah.
So then the volumes were insane. Turnaround times were kind of garbage. And then the lender's like, well, this is crazy. So the volume is crazy. We have to either hire people or just jack the rates up because we can't hire.
Because you can't.
You can't stand the volume, right?
So
Supply and demand.
What percentage, like what percentage increase were refis? Because I guess that's what you're talking, right? It's like refis, like that exploded, right?
Yeah, I mean pools.
Yeah.
Pools, hot tubs.
Well, yeah,
luxury,
yeah.
Finishing basements.
Everything and anything people wanted to do to their homes.
People were pulling out 100, 150.
Yeah. Well, I mean, I remember talking to you. Like, we had been saving for a pool for 7 years. And then it was like, okay, well, if money is so cheap, why are we putting our cash at doing up our backyard when we can, sure, do some cash, some refi, and then just go and invest that money and get a return,
right?
Like a much better return.
Absolutely.
Right?
Yeah. So, I mean, and that's all the money game. And going back before I was in mortgages, I was in the financial planning business.
Yeah.
So you have that consultation, you have that with clients. And, you know, the bottom line is, what is it going to cost you versus, you know, how long is it going to save? So if I'm going to save 7 years for a pool, but in 7 years pools are now $3,000 or $300,000, how much money did you save? Yeah. Because you'll never have.
No, and
right.
It's funny you say that now because it's like really when we first started looking at getting the pool and what it was going to cost to like when we pulled the trigger and actually did it, it was more than double with what we did to our backyard.
Yeah, cost of waiting, supply and demand.
Yeah, and so it's kind of like after now that we've gone through that, there's certain things that have changed my thought process on stuff. And one of those things, like right now, it's like when people talk about, like right now, oh, you know, mortgage rates are going up, housing prices are going to come down more, I'm going to wait. Here's the problem. I think more often than not, when we play the waiting game, in the end, we are worse off.
Yeah, I mean, there's the old adage, buy real estate and wait, don't wait and buy real estate.
Right.
And I mean, let's talk about London, though. Everybody's talking about bubble. This goes up, this goes down. Everybody knows that in Calgary, more often than not, with the price of oil or whatever it goes up. There's way more fluctuation in Calgary.
Calgary's a yo-yo.
So, I mean, it's crazy. And, I mean, you can still buy condos for like $89,000 in Calgary.
Yeah, it's wild.
It's crazy.
Yeah,
right?
that doesn't exist in Ontario.
But in London, it's so steady.
Yep.
I mean, there's obviously the variant with COVID, just like everything else, to an extreme. But that's what happened. I mean, the values went crazy, and everybody's like, all of a sudden, you have, you know, all this equity in your home, so you're accessing that. Or on the purchase side, people are selling, and now they have like 50% down because of all the equity and the increased value. So everybody upgraded.
Yep.
So everybody upgraded, and it was great. It was a great time. Like my business went up about 40% during COVID. It's just because, but the other thing that happened during COVID because of this was I was always kind of 80% purchases, 20% refinances.
Yeah.
And it switched to 50-50, like first week.
Really?
I've never seen that swing in my career.
Yeah.
So I mean that was crazy. So I mean just dealing with that, and I mean the rates were pretty good. Refinance rates are generally higher than insurable purchases, right?
Yeah.
But I mean you're only talking about 20-30 basis points at the time, so well worth it still.
Yep.
So with COVID, I mean, basic economics is the government is trying to control the supply and demand of things.
Yes.
So prices were just, demand was high, obviously price is going to follow.
Yep.
Because you either can't get it, so you have to make more price per unit, or you just want less people to buy it, so you price it out of the market.